Welcome to That Annuity Show, the podcast that will make you an expert in explaining annuities to your clients. Give us 30 minutes each week and we'll shave hours from your client presentations. Now, here's your host, Paul Tyler.
Hi, this is Paul Tyler, and welcome to another episode of That Annuity Show. And as we're coming up to the end of another quarter, we are fortunate enough to have our Chief Investment Officer, Mr. David Czerniecki, here with us again. David, welcome.
Hey, Paul. Thanks. Happy to be back.
Yeah, well, thank you very much. We have a number of topics, and you also have a guest, correct, who will help us address one.
That's right. We're being joined today by John Beshoory. John leads our infrastructure, energy, and renewables portfolios and all of our investment activities there. Yeah,
well, thank you. Welcome, John.
Thank you for having me.
Thank you. And I guess maybe we dive into a topic of your expertise. My question is, why is energy now suddenly a sexy sector? I've seen investors link energy investment strategies to the boom in AI and the need to power a lot of these data centers that we think will be popping up around the globe. What is happening here, and is this should we be looking at energy in a different way?
Yeah. Okay. Thanks. I think that there is definitely a lot going on. The sector is fundamentally changing. There are many transformational changes, but I think fundamental changes always occurred, as we'll see here momentarily. And the sector is getting great press, I think partly because it's so easy to communicate and see the changes, real time basically, and they seem to be happening very quickly. So I just want to talk a little bit about supply and demand drivers, and maybe that'll hopefully address the question that came up. If you look at the supply side, until about 1850, U.S. energy consumption was virtually 100% non-fossil fuel. Then coal arrived, and in 75 years, energy consumption tripled. That's a fundamental change. Then until 1910, there was virtually no natural gas or oil production or consumption. By 1940, that represented more than half of our energy consumption. Again, another fundamental change. Then renewables and nuclear and things like that came along. And looking forward into the future, consumption is projected to increase by about 35% over the next 30 years or so. Meanwhile, solar will grow from a 5% share in 2022 to about a 35% share. So again, that is a huge fundamental shift. Wind is going to grow from 10 to 20%. Now, these are all being driven by favorable regimes, policies and tax incentives and things like that, but also by costs coming down. So they are working in tandem. Meanwhile, traditional sources of energy, natural gas, nuclear, coal, are all going to be decreasing as a share of the energy pie. So the shift to wind and solar definitely does represent a fundamental shift.
Yeah, and just as a follow-up question, from a macro perspective, do you see the energy sector really sort of keeping pace with our typical industrial growth, or do you see it? Do you see technology itself having a fundamental impact on the demand?
Technology is a big driver. We're seeing that there are greater efficiencies, in terms of heat pumps, in terms of all of the equipment that we use on a day-to-day basis it's becoming more energy efficient. So that's partially what's driving, the shift over here. But I wanted to touch on AI because that's on the demand side. So you asked about industrials on the industrial side. So the electric consumption is only projected to grow about 30% or so in the next 30 years. But that the most of that growth, or a biggest chunk of that growth, comes on the industrial side. And what's driving that is AI and data centers specifically. So if you look at data centers, they will account for about 2/3 of the growth on the industrial side. And between 2022 and 2030, they're projecting that power demand for data centers is expected to quadruple. And of that, about a quarter of that increase is coming purely from AI-related purposes. If you look at AI in general, just reduce it to a few snippets. When you do a chat GPT query, it consumes about 10 times as much energy as a Google search. So there are more and more of these queries going on, so they're consuming more and more energy, and so that's a big driver. Then, if you look at it another way, AI currently, and AI and cyber cryptocurrency and data centers account for about 2% of global energy demand in 2022. They're expected to double here in the next couple of years. And if you think about it, 4% of global energy demand, that is Japan right there. So data centers and things like that will consume a ton of energy and be a big driver of energy growth.
Interesting. Well, I'm probably helping build Tokyo with the rate I'm using generative AI these days. Well, David, just talking, a big picture about AI. So, I think we've had some very bullish conversations in the past about that. I personally invested stock or purchased, stock in some of the chip companies, and it's been a good bet so far. But is this? Do you think this is going to turn out to be a tulip bubble, or will we really see fundamental restructuring as a result of this new tech?
I'm going to answer you in a second, Paul, but before we dive in, I'm going to just point out to our listeners that Paul's past performance is not indicative of your future results. And if Paul retires and I get stuck with this show, we're going to have a big problem. So, no, Paul, it is, I think, my thinking continues to evolve here. It continues to be positive. I mean, you heard what John just said about the energy consumption. People aren't spending that money to increase their cost of doing business. Okay, they're spending it to gain benefit, whether it's growth or competitive advantage, or to lower their costs because some of that technology is replacing other things. So it will be beyond just college papers. It will prove to be a pretty big productivity boost here. I think. Two things I would say, Paul. I think, in terms of maybe three things. In terms of the innings, to use that analogy, I don't know, we might still be sort of in batting practice here before the game. I think we're pretty early on in this. Now, remember that technology has been around for a long time, but in the last less than decade, I think we've made a pretty big quantum leap. Mm-hmm. And I think it's as big as sort of the advent of the internet or something. Now, how does it play through? Lots of speculation, lots of guesses. Again, if we're still in batting practice, who knows what the first pitch is going to look like? But what I would say is this. Think about it from the standpoint of a range of possible contributions and how that might vary depending upon the subsector you're dealing with. So let's kind of frame the ends of it. On the one hand, typical investments in technology might get you a 30% productivity boost. When we all put computers on our desks, we became more productive, right? When I started, we didn't have computers, right? And so that's a cost savings. And so there's going to be an element of that where I think the joke was that AI will make humans less robotic, because there's a lot that we do every day that is mundane. And all of us, regardless of our job. And so you can see where you'll get a contribution in sort of a productivity boost from that. So that's probably the low end of the contribution extreme. And that might cut across routine tasks. When you do your online chat to buy your next, widget that you need for your backyard or whatever, right? It's probably a chat GPT or somebody like that's AI is who you're talking to. It's pretty routine. Is it blue? Is it white? How big is it? They're answering simple questions. Productivity. Take the opposite, or sort of the other end of the spectrum, where it could, potentially do some really complicated things in some really complicated jobs, and some really complicated analysis. And in that case, you may get a huge productivity boost or a replacement for a human, robotics on an assembly line or something like that. And but I think what we're going to have to start thinking about is sector by sector, job by job, role by role. I can easily see a scenario. I mean, John is an expert in his field, and he's been our anchor in this investment strategy for some time for us now, and he's done a great job. I can see a scenario where in a few years' time, John's number one sidekick every day is his AI programs that are helping him do his research and analysis. And I would venture to guess that without that, some of his competitors could outperform him. I think he will need that tool to help him do his work. And so, but again, I think you got to look space by space and sector by sector to see how that plays through. But it's going to be big.
Well, no surprise. I agree with you, David. And, I heard somebody say it last week. It's interesting. You listen to so many people. So you sometimes can't remember if it was in person or a podcast. And they said, "Don't call it artificial intelligence. Call it augmented intelligence."
Right. I've heard similar thoughts like that. So, right.
And exactly. And I also heard somebody say, yes, of course, this will cut jobs. That always is our goal, is to be more efficient as an economy. And, other opportunities pop up. But on a related note, inflation. I already see the technology impacting inflation. I went to McDonald's. I don't go there very much, but first shock was, I ordered a sandwich and a drink, and the bill was $18. How did this happen? But it also, mostly people are putting orders to the kiosk, and shame on me, the woman said, it would have cost you less if you'd ordered through your app. So inflation looks like it's stabilized. At least last month, if last month could be a trend. Do you think that this is signs that the Fed policy is actually played out, or is it just sort of a blip in the data, and we may still be talking about inflation a couple months from now?
Oh, I think we'll still be talking about it a couple months from now, Paul. I wouldn't call it a blip. What I would call it is the normal process of sort of taming inflation, and that is, and maybe there were some unique things in this cycle because of COVID and the supply chain disruption. And so we saw this, you recall, we saw this huge spike in the cost of goods and then services. And then as the Fed made progress and the economy reopened and things like that, we saw a pretty steep decline, from 9% down to 5% happened pretty quickly. From 5 to 3 has been more difficult, and part of that is some areas of historically some areas of inflation do tend to be more sticky. Wages being one of them, services tend to be stickier than goods, et cetera. So what you're seeing play out now, I think, is this sort of what we call in investing sort of hand-to-hand combat, where the Fed's blunt tool of interest rates is sort of tackling this problem and that problem kind of one at a time. And you've got, sort of innovation and technology. In order for McDonald's to get the cost of a Big Mac or your whatever Happy Meal you got down, right? You have to, you've got to lower all your costs. Labor is an important input. You've got to bring, you're bringing on this technology and the kiosk and the app, et cetera. But there's usually upfront costs associated with that, right? And so they need to get all of their volume on that kind of basis. So what you're seeing is these little, 2 steps forward, 1 step back kind of thing. We talked before, Paul, about the last mile. And the last mile is always, the hardest part of the race course. And that's what we're in now. And I'm not 100% convinced the Fed gets us all the way to 2%. I think they would like to. But I think before they take any meaningful action, they're going to want to feel pretty comfortable that they're on a solid path to get there. And we're seeing that bounce around. You mentioned, sort of, some general costs, but there are other things. We saw a couple days ago where the JOLTS report, sort of the job openings were diminishing. That's usually positive from a cost perspective, i.e. bringing the cost of labor down. Then today we saw, the employment numbers come in much stronger than people thought. So now that's not a positive from a labor cost perspective. I.e., labor costs are more likely to go up. Again, getting back to supply and demand. but there's still fewer job openings than there used to be, and so the trend seems to be heading in the right direction. But again, it's going to be a little a little progress and a little slippage, and a little progress and a little slippage. I think we're going to be living with this uncertainty for another couple of quarters.
Yeah, we are living in strange times. I saw a headline, I don't know if this was clickbait or not, I think a day ago, that said there were more job openings than unemployed Americans.
That's been the case for a while.
Has it?
Yeah.
Interesting. Now another number I saw was retail sales. I think this last month the government came out with the sales report. I think that general merchandise was down. Now, speaks to, is that speaking to customer? Should we look at that and say this is a sign of lack of consumer confidence, or is it actually a good thing? It means that this is one leading indicator that maybe the inflation starts to slow quicker than we hope.
Yeah, I think look, inflation and jobs, employment, and inflation and GDP, are all, sort of these things that are two sides of the same coin. And the Goldilocks scenario, of course, is that we maintain this incredible level of employment in the U.S. Where we're sort of we're almost through full employment, and get inflation under control. That's the soft landing. That's the Goldilocks. That's hard to do. Typically, something has to give, and in order for inflation to come down, the economy has to soften. Now, let's hope it's not a recession, but it has to soften. Job growth probably has to slow. Wage growth has to slow. I mean, wages are a big part of where dollars are spent. So it's hard, Paul, to say that slowdown in retail sales it could be suggestive. It certainly could be suggestive of helping to bring inflation down. But that may be because it's coming. It's likely that it's coming at the expense of consumer confidence, disposable incomes, and people's willingness to spend. Yeah. And we've seen the consumer confidence index come down a little bit, Paul.
Yeah, I know, and we've also seen all the news of elections, which are still seem to be quite a ways away, heating up. And I guess a question for you is, will politics actually impact the 60-40, 70-30 type of equity to bond allocation recommendation we're all kind of used to giving our customers, given how political the Fed has become? Bill Gross put an article out suggesting that the presidential election may have a significantly long impact on the outlook of bonds. Is that hype, or is that something we should actually think about when we look at the results in November?
Well, there's a few things, Paul. There's a lot embedded in there, and so let me kind of go through it step by step. Like the 60-40 thing is not an or 70-30 is not an awful rule of thumb, but as you know as well as I do, particularly given the amount of contact you have with retail investors and individuals and annuitants in our business, is that each specific circumstances is very unique and very different, and my 70 is your 60 and vice versa. In fact, you've made so much money in the chip stocks, my guess is you could put all the rest of it in bonds now. But anyway, so
$10, David.
You have to take it with a grain of salt. Having said that, I did see what Bill said, and I think a lot of people agree with Bill Gross, and I think you'd have to be always be a little bit cautious about disagreeing with him, given the track record that he's had. But having said that, the point that Bill made was that a Republican/Trump win would likely get us a scenario where we saw, perhaps tax cuts, or certainly not rises in taxes, but with increased fiscal stimulus, fiscal support, and things of that nature, and that what Bill didn't say, but I know what he meant, was that would again increase the deficit, therefore increase our cost of carrying that deficit, particularly at a higher interest rate than we used to have. And that in and of itself would be inflationary. The deficit concern is a big one. It's been out there for a long time. It will continue to be out there for a long time. The counterweight to that is, and I wouldn't say it's a true counter, but the other thing is any new legislation, any big changes in the tax laws or in fiscal programs are going to require the approval of the Congress, and that part of the election will also be important. And I think, without getting too far into it and speaking well beyond my area of expertise, you're not likely to see a landslide in either direction here. I mean, given the way that things have gone and the number of seats that are up for contention and kind of the way our voting system works and the districting and things like that. So yes, it is certainly, either candidate could win the presidential election. It doesn't necessarily guarantee that the Senate flips. It doesn't necessarily guarantee that the House doesn't flip, and so on and so forth. So those three groups still have to work together to enact anything.
Yeah.
So.
Well, this has been great, John. I'll throw you out hopefully it's not a curveball, but when I talk to most people about investing in the energy sector, a lot of them are focused on the dividends from a number of these companies. Do you think, solar, nuclear power, does that sort of shift how people look at the energy sector? I'm not suggesting everybody should or they would, but, my biking friends have been buying these oil stocks for dividends for a while here.
Yeah. So, when I think of dividends in the energy space, I think of utilities and companies like that. And I think you're seeing more and more of them, set up solar projects and solar farms and this, that, and the other. I live in Florida, and I know Florida Power and Light, NextEra heavily one of the largest investors in that space. I don't know if I know enough about the rest of the world, but my sense is that if you're looking dividend investing, I think it's still too early stage to say that you should be looking for dividends out of these projects. They're more growth than anything else, as far as I can tell at this point. And there's such a lot of runway for them to grow that I wouldn't be looking at them as sources of dividends anyway.
Okay. Well, and David, one last question for you.
Sure.
If I'm trying to prognosticate about what the economy may look like by the end of the year, what are the key things, reports, events over the next couple of months that will kind of signal where the economy is headed?
I think the key things you're going to want to keep an eye on is we all need to keep a very, very watchful eye on the inflation picture. I think the job market. I think these are the two linchpins still. Having said that, I would look at consumer confidence, and I would watch. The other two things I would watch is consumer spending and sort of the position in household debt.
Okay. Well, great. Listen, John, thank you for making a guest appearance, and David, as always, thanks for your time, thanks for your insight, and I know our listeners will certainly appreciate it. And if you are listening, give us feedback, but be sure to share this show with your friends and colleagues. Thanks so much. Join us again next week for another episode of That Annuity Show.
Thanks, Paul.
Sure. Bye.
Thanks for listening. If you've enjoyed the show, please rate and recommend us on iTunes, Stitcher, Overcast, or wherever you get your podcasts. You can also get more information at thatannuityshow.com.